Ba-dum-bum-bum. Hey now, folks. Good morning, one, and good morning, all. Welcome to The Street today, here from Post 35 on the floor of the NYSE. Today is Wednesday, March 8th. Happy International Women's Day, one and all as well. I'm your host, JD Durkin. We're about an hour or so into trading. Stocks pretty flat, kind of muted opening, kind of fractional mixed territory. We're all just trying to figure out how the dust settles after yesterday's session. Of course, Jay Powell indicating interest rates would need to stay higher for longer. He spoke to the Senate yesterday. He's currently testifying in front of the House Financial Services Committee, and we will bring you those updates as we hear them. On the show this morning, we will talk Fed. Of course we will. Today ends in Y as investors finally take Jay Powell at his word. It took a while. It took a long while to get here, folks, because up until now it's been like, the man speaks. We're not really paying attention. We don't believe him. Now it does not seem as if we are in that territory any longer. Plus, we will dig into the labor market ahead of this Friday's big jobs report. Did you know it's almost jobs report Friday, folks? I'm very excited. I got my snacks all lined up. Plus, we'll tell you why the National Highway Traffic Safety Administration is opening a probe into Tesla. And finally, we will tell you why Adidas is warning of its first annual loss in 3 decades. 3 stripes, 3 decades. For more on these stories and much more, let's bring in Mr. Martin Baccardax, our senior editor and our chief markets correspondent. Good morning, Martin.
Good morning, JD. I just had my head pointed to the right. I was looking at bond yields this morning, but it's kind of fun to watch the reaction today, isn't it? It's hard to take your eyes off the bond market screen when you're looking at stocks these days.
So I'm glad you said that, because we're going to get into it here in just a bit, and I do want to get your read on both the 2 and the 10-year, mostly the 2, because we did see it move north of 5%. But first, let's talk about the catalyst for all the movement we saw, and that's, of course, Mr. Powell's testimony in the Senate. So before we get to reaction across markets, reaction from lawmakers, let's first take a look at what Powell said, and I'll ask you about it on the other side.
As I mentioned, the latest economic data have come in stronger than expected, which suggests that the ultimate level of interest rates is likely to be higher than previously anticipated. If the totality of the data were to indicate that faster tightening is warranted, we'd be prepared to increase the pace of rate hikes.
All right, so that's largely what Powell had to say yesterday. He's continuing similar testimony currently to the House. From what you heard, Martin, did he deviate at all from prior public comments?
Maybe not necessarily deviate, JD, but he certainly added subtleties that clearly had implications for financial markets, not only stocks, but rate markets and rate traders as well. I think that comment there was probably the money clip, in that the word totality of the data, at least in my mind, was meant to reference the fact that he was speaking to the Senate prior to JOLTS data this morning, payrolls on Friday, and a very key reading for February inflation on Tuesday of next week. All of that data, of course, will be rolled into the Fed's thinking when they begin their policy meeting on the 22nd of March. So I think to some degree what he was trying to tell lawmakers was that, yes, we've had stronger than expected data. If it turns out to be consolidated in the sense that we expect inflation to accelerate further, then we're not afraid to go harder. Our assessment prior to that was that we could probably live with 25 basis point rate hikes, but what we're seeing in the data now suggests we may have to go just a little bit harder to make sure that we get the job done. And furthermore, that job may take longer than first anticipated.
And it's interesting because in his opening testimony this morning to the House of Representatives, he cited those exact data points. Chairman Patrick McHenry asked him directly about the March meeting, and he said, well, look, we got a lot of data points. This was just 10 minutes ago. And he said, look, we got a lot of data points. We got obviously jobs Friday. We got CPI and PPI next week. And yes, to this point about jobs report, it'll be interesting to follow. I also always am curious, if he had his choice of things, would he rather speak to members of Congress after getting big jobs data? But the point about JOLTS, he did say he didn't yet see the JOLTS data. That's what he said anyway. He said, because I've been sitting here since 10 o'clock. The data came out at 10 o'clock. He did indicate here the terminal rate will likely be higher than anticipated, higher for longer. That's the name of the game right now, isn't it, Martin?
Certainly seems so. To your point about whether he'd rather speak to lawmakers before or after, I get the sense that he'd rather not speak to them at all, particularly when you consider that exchange that he had with Elizabeth Warren, who I felt was really probably, pressed a little bit too hard on some issues that the Fed chairman just simply isn't responsible for. But nonetheless, we do have that delayed jobs report, and had it been a normal month, it would have fallen last week, and he would have been armed with that piece of information prior to going in to the Senate Banking Committee and indeed to the House Financial Services Committee today. So it's a quirk of the calendar. What can you do? I think he just laid out, though, the case, and it probably suggests that unless we get a real deviation from anticipation on Friday, there isn't going to be a great change in the Fed's reaction function, and rightly so. They need to be data dependent, but they also need to see that data form a consistent narrative before they begin to change tack. And I think he's sort of right to express it that way. But nonetheless, it wasn't long ago, JD, that we sat here talking about disinflation, largely because he had mentioned it 15 times in his post-rate meeting press conference. And there were suggestions that despite the tight labor market, we were seeing easing pressures with respect to consumer prices here in the U.S. economy. And that simply hasn't turned out to be the case. There's all sorts of arguments as to why, some good, some bad, some indifferent, but it doesn't change the fact that those interest rate levels are elevated. And given the Fed's mandate, the central bank really doesn't have any choice but to use that blunt instrument, even if they feel in their heart of hearts that those pressures are coming from areas of the economy that won't be affected by higher interest rates.
I'm glad you mentioned the disinflation count, because we certainly did talk a lot about it, because he talked a lot about it. But I wonder how much more cautious he may be seeing the reaction that led from those comments. We're all counting the number of times the man said disinflation, and I wonder if he sits there and says, my good thing, you know what? People, you can't, it's like damned if you do, damned if you don't. I'm sure he sits there frustrated sometimes. But, you know, you brought up Senator Elizabeth Warren. It was a notable exchange. They sparred a bit yesterday on the issue of unemployment going up and the number of Americans who would find themselves out of work as a result. The Senator of the Commonwealth asked the chairman of the Fed, do you know how many people? He said he did not know, which I find hard to believe. He just probably didn't want to say it. But I also couldn't help but notice, Martin, and I think you'd agree, with all due respect to Senator Warren, she did not offer any alternatives to combat inflation other than raising rates. Her concern is the, as she said, 2 million people who would be out of work, but I didn't hear any back and forth to say, well, instead of raising rates, you could do X, Y, Z. What did you make more of that interaction, if you're willing to talk about it a bit? Because it's certainly the most played clip of the morning today.
Yeah, for certain. I'll preface all of this by saying I've interviewed Elizabeth Warren on a couple of occasions, and I found her to be a profoundly intelligent person. She is very sharp. She was able to sort of transition to my questions at least very quickly and come back with answers that I certainly didn't anticipate, but I thought were well considered. However, she does come from a perspective of very much as a consumer's advocate. And I don't necessarily think it's a bad thing, but to some degree, we have to see her questioning and some of her motivations through that prism, because that's precisely who she was speaking of and for when she was challenging the Fed's mandate. The Fed's mandate is what it is. It's very difficult to maneuver when you have that twin responsibility of full employment and price stability, because every economist, and even those sitting in first-year freshman university classes, will tell you that they are very often contradictory. It's hard to get full employment because that, for the most part, requires an accelerating economy. And unless that economy is profoundly efficient, it's going to generate inflation along the way. Finding that equilibrium is incredibly difficult and sometimes requires Sophie's choice with respect to the mechanics that you deploy to meet it. And that's exactly, I think, what the Fed chairman was trying to reply, but he was getting severe and indeed at one stage personal attacks from Elizabeth Warren, which I did not think were fair, particularly when she talked about the need for a new Fed chairman if he wouldn't, inverted commas, fight for families. That's really a soundbite that's going to be used in her constituency more than is going to have relevance or pertinence to this very complicated debate.
I knew you had thoughts on it, which is why I wrote the question earlier today. I was like, I got to ask something on Warren because I know Martin has thoughts.
Not that
on
I've given it.
And listen, no, of course, but it's great context. And every time you have these high-profile testimonies on Capitol Hill, any lawmaker is going to use it as an opportunity less to get information, less to learn. And it's much more sometimes about just making a statement, getting those clips that go viral, they get cut into campaign ads, and they serve, to your point, their home constituencies. You see it when Zuckerberg's on the Hill. You see it when Powell's on the Hill. And as we joked about yesterday, no shortage of political theater. What was interesting to watch was the CME Group's FedWatch number tick up and up and up. Where are we as of this morning in terms of 50 basis points for the March meeting, Martin? What happened?
Well, it's so funny. Your illustration of it is perfect, JD, because that's exactly my experience as well. It went from 32 to 48 to 62 to 72, and it seems to be hovering right around that level. There's a curiosity in that number, though, JD, and it's being reflected in most of the research that I'm read this morning and some of the comments that I've seen on television and elsewhere. Whilst the market is anticipating that fatter rate hike, a 50%, a 50 basis point hike on the 23rd of March, most people individually think that the Fed is going to stick with 25. So I'm interested in the sort of dichotomy of those two views and exactly how it's going to play out. I'll confess myself that I think the Fed is going to stay with 25 and probably extend cuts into July and August. 50, unless, again, there's a blowout number on Friday or with respect to jobs, or on Tuesday with respect to inflation that we just don't see in the windscreen, a 50 basis point rate hike after having gone back to 25 in February is going to be seen as a policy mistake. And that would be two significant policy mistakes within 2 terms of Mr. Powell's chairmanship. And I just don't think that anyone's prepared to countenance that, because that would ratchet up the criticism. So I think it's a trading opportunity more than a reality. I very much could be proven wrong. But my gut at this moment, JD, tells me that the Fed is going to stay with 25 simply because they can and should. And if they extend rates in the way that they are likely to, they'll have the flexibility to accelerate if they absolutely have to, but they won't have to back off quickly if 50 turns out to be too much. There's just a lot more flexibility in higher for longer than it is in going hard and trying to snuff out an inflation story, which remains, again, exceedingly complicated.
Right, because right now, if you look over the 8 increases, you start at 25, you go to 50, you get 4 consecutive jumbo rate hikes at 75. Then you start to taper down. You went to 50, we had 25 then in February, that made the 8th.
Yeah.
And now to your point, if you go up to 50, you don't have this nice little kind of uphill and then drop down. You're kind of starting to shoot this thing back up. And I think it's a great read to say it would be seen as a policy mistake already a year plus removed from the whole transitory controversy.
This is just it. And JD, this speaks to this whole notion of Fed credibility, which is something to a large degree I tend to dismiss. I mean, we can say the Fed doesn't have credibility, and then what? Do we go to the other Fed? Like, there's no alternative. These guys are setting the rules, and that's it. So whether they have credibility or don't seems to be a little bit irrelevant to me. But at the same time, you certainly do want that policy credibility, at least with respect to how markets are going to react to your decision taking, because that is going to lessen the impact on financial markets and therefore, as a byproduct, the impact on American investors and taxpayers, because of course so many people's 401ks are intertwined with the reactions in financial markets, both short and long term. So the Fed has a responsibility to be credible, but the fact that it loses credibility probably isn't as significant as someone at Wall Street would like to say. Nonetheless, you do want that trajectory that you just laid out to be more predictable rather than less. You don't want the gyrations from 75 to 50 to 25 and then back up and then back down and then back up, because it gives the impression that you don't understand the dynamic that you're trying to control. And I don't think the Fed wants to send that message, irrespective of whether it's concerned about credibility.
Do you think Jay Powell watches the markets, and if he does he care?
I do, and I do. I think he has to care. Financial conditions are certainly a very important component of controlling inflation, and he doesn't want financial conditions to get too far ahead of Fed policy, because they can become inflation stoking in and of themselves. So he has to be wary of it, but he also has to sort of give the indication that he's not worried about it on a moment-to-moment basis, and rightly so. I mean, it's a cliche to say it, but none of us really know what moves any particular stock on any particular day and for whatever particular reason. There does tend to be a mystery to all of it as a result of algorithms and the gigantic money that's traded publicly, plus dark pools of liquidity that we just don't have any knowledge of. So it would be foolhardy to try and control markets in the short term, but he undoubtedly has to be he has to respect what they are doing in the context of his inflation fight.
All right, now I do want to ask you about the market implications. I love that we've had this whole conversation. We haven't even really touched on stocks or bonds and their reactions yesterday. All three indexes down deep in the red, all 11 sectors of the S&P down, I believe. We did see the two-year note to our very first part of the conversation today go above 5% for the first time since 2007. I'm sure you also track the spread between the 2 and the 10-year, which I believe inverted as for more than a full percentage point for the first time in a long time as well. I don't know currently where the 2 year's at, but I'll pull it up in a second. Why did markets finally start paying attention? Or is my description of it not right? Do you not agree with me that this really is the first time that people tried to finally take Powell at his word?
I think that bond markets were on the way to taking Powell at his word. But I think, again, because he talked about the potential for faster rate hikes, it put the 50 basis point discussion into play. And that just added sort of acted as a magnet to short-term bond yields, which are the most sensitive to interest rate changes. Longer-term bond yields tend to be more sensitive to growth outlooks. So what you have now, JD, is you have the difference between 2-year and 10-year Treasury note yields trading at around 110 basis points, about 1.05% to clip it in the middle. That's the steepest inversion, as we describe it, since August of 1981. So those who have been dismissing the inverted yield curve as a potential recession signal are starting to capitulate. And as a result, the curve is getting steeper in the inversion along the way. I am seeing more and more commentary, Brian Moynihan, the CEO of Bank of America being the latest, suggesting that the recession is likely to find its way into the economy in the second half of next year. It could be shallow. We don't know the depth. We don't even know if it'll happen. But it certainly seems to be an accelerating risk. So to some degree, that was the mechanics behind the moves in bond yields yesterday. But that 2-year yield, I think, JD, is notable for a host of reasons. The first and foremost being, if you're an investor with a short-term sort of goal with regards to what you're going to do with your finances, let's say you're saving for a house that you'd like to put a deposit down on in 2 years' time, you now have a risk-free, and by that I mean literally, risk-free rate of about 5% or maybe just a little bit more. You don't have to worry about any of the things that we're discussing right now if you go into that 2-year Treasury note, because you're locked in. That is a compelling alternative, not just for those who are saving for houses, but for a host of investors all around the world. And that's a challenge for stocks, and it's a big part of the reason why we saw that downturn yesterday.
I could do Fed Talk with you all day. I truly could. Unfortunately, we do need to move on slightly to a few other topics, but maybe I'll call you later, as I did last week. I called Martin for extra questions. Sometimes we do a special overtime, like an extended edition of the show, just me and Martin on the phone, just talking things through. Maybe we'll do that later. Let me ask you here about ADP. I don't know if you saw the ADP figures, the payrolls out earlier today, showed private payrolls rising last month by 242,000. We should remind viewers, however, that last month, ADP payroll showed 106. That was the number just days before the monster 517 day. I know you've got some dose of skepticism by which we should greet ADP. How much stock, literally, should we put into a number like this? Or is it kind of like, we put an asterisk on it, we see what happens Friday?
Yeah, it's one of those numbers, JD, that I don't want to dismiss completely because I think there is importance in gathering. It's better to have more information than less, I think, all things considered. And ADP isn't just throwing this number into the wind. It's reasonably well researched, and in fact, it has been changed in terms of its methodology a few months ago in order to sort of get rid of some of the vagaries that we've seen in the monthly figures. For those who aren't completely familiar, ADP is a payroll processing firm, and therefore they have deep data from which they can mine sort of changes in payroll activity and using that to interpret how they see payroll additions and therefore changes in employment over a particular month. That change in processing, though, has only taken place in, I think it was July, I think August or September, if I have my memory correct, were the first instances of the new methodology. And it's undershot payrolls every single month since. Now, that's a very small data set, so we can't dismiss ADP completely, but nonetheless, there isn't enough of a track record to use it with any great confidence. Therefore, it's a piece of information that we can note, but it hasn't given us a clue as to what's going to happen the coming 2 days later when we get non-farm payrolls, and that's really the number that everybody's focused on.
at least one number some people might be focused on today is the JOLTS data. It did come out at 10. We heard Mr. Powell say, well, I don't know the number because I've been sitting here since 10 o'clock, but we know the number. 10.8 million versus an expectation to have that number trimmed a bit. Some people thought it'd be 10.5, 10.6. So we're coming down from 11 or so. I mean, the popular go-to line will still be nearly 2 open jobs for every 1 American who's seeking work. But as you and I have talked about before, maybe there could be some distortions to the JOLTS data. So give me your sense on how we take a number like this.
Well, there's a couple of ways to take it. The first thing I want to say, JD, is I loved the chairman's answer with respect to that, because it illustrates how differently men and women in those positions have to react as opposed to us. When Powell said he didn't see the number, he may very well have seen the headline figure. But what he's telling lawmakers is, I haven't had a chance to put these numbers on my desk and pour through them in great detail. And therefore, I'm not going to give you an answer until I am confident that I understand it. That is the sort of academic rigor that people in those positions have to deploy when they're looking at these sorts of things. Someone like myself, I can talk off the top of my head. I'm trying to do the best I can, but nonetheless, I am not delving into these figures in the same way that he is. So as a result, I just thought that was a funny aside with regards to how he is going to interpret data. He's not just going to speak as a result of the headline. He wants to understand the guts of the numbers. But the numbers themselves, JD, have remained a mystery for many people for a number of months now, because they simply haven't reflected, or at least they don't appear to reflect, the pressures that we're seeing in the labor market. There really isn't a great idea as to why we should have such an elevated level of unfilled positions when we are seeing headline job cuts across a bunch of sectors and all sorts of concerns with respect to a pullback in consumer spending. Now, there's a couple of ways we can look at this. Companies might leave job postings up, even if they don't intend to fill them, because it doesn't hurt them in any way to carry on attracting potential candidates, even if the position isn't live. So that could account for a small number of them. The second thing we might note, JD, is that people who have already been fired have no need to quit. So they're not going to show up in JOLTS quits data either. So there's a couple of quirks within the mechanics of putting JOLTS numbers together that probably make it an unreliable barometer of where we're heading in terms of jobs data. But again, much like ADP, it's something that the Fed uses as part of its toolkit, and therefore we can't ignore it. But I think you're right to say that it remains much more elevated than people thought, even as we head into the third month of this year.
And maybe the word totality is the new disinflation, because that's the word he used yesterday, totality. And so when you say totality, you say, okay, hey, it's a little bit of everything, right? It's going to be the JOLTS data, CPI, PPI, the jobs numbers, average hourly earnings, right? Unemployment, all these things we'll get between now and the next FOMC meeting. Okay, let's shift our attention now to Tesla, if we can, with our remaining minutes here of the show. Shares of the EV maker are down yet again this morning. What is going on there, Martin?
Well, we had a couple of headlines overnight, JD, that are putting more pressure on the stock. I think it's down about 10% so far this month, but I mean, it's had a roaring 2023, nonetheless, up about 70%. Elon Musk has been bullish about the company's prospects, particularly from the demand point of view. But investors, particularly on the analyst side, are starting to look more closely at profitability. In other words, what kind of margins, both operating and automotive, is Tesla going to be able to work under if it's cutting prices of its electric vehicles and consumers are pulling back on spending. That was something that was raised by Berenberg Research overnight. They lowered their rating on the stock to hold from buy, although they boosted the price target by about $10 a share, essentially saying that, yes, this company has a long-term advantage because of its first mover conditions in the EV market, and it's a compelling brand. That simply cannot be denied. But in the near term, these price cuts are going to pressure margins, and the situation in China, where about 40% of Tesla sales are generated, is still uncertain. That economy has been stalling, really, even since its post-COVID lockdown lift. The trade numbers are not particularly strong, and China's GDP growth target was significantly lower than analysts had forecast. So you bundle all that together, and you start to get maybe taking some air, if you will, out of the balloon that has been Tesla stock so far this year.
Absolutely. Okay, let me ask you about this next one here. The National Highway Traffic Safety now opening a probe into over 100,000 Tesla 2023 Model Ys after reports of steering wheels falling off. How big of a blow you think that is to the company?
It's that one's hard to say. The NHTSA has gone after Tesla just on so many occasions, and this is just the latest. I will confess I have some sympathy for Mr. Musk with regards to his tete-a-tete with this organization, because it does seem at times to be a little bit vindictive. But that said, when steering wheels are falling off, there's a responsibility from any agency to look into the reasons why. And this is a little bit worrying. It seems some 2023 Model Y sedans have been delivered to customers without a proper fix, if you will. And by fix, I mean literally, of the steering wheel inside the driving compartment. And as a result, it has come off in one case, which I think the NHTSA shared through their Twitter account whilst the person was driving the vehicle. So they want to look into this, whether it's a manufacturing defect. But it simply does raise the sort of headline risk that Tesla has faced with regards to some quality issues associated with the cars, particularly here in the United States.
We did see some price cuts for two of Tesla's most expensive vehicles yesterday. Raise any margin questions? What do you think we should know there?
Yeah, that is going to be the key component of understanding Tesla's earnings potential going forward. Mr. Musk has been bullish about demand, and he has said on a couple of different occasions, not only during his post-earnings conference call in February, but on the Investor Day in Austin on the 1st of March, that price is an exceedingly important component in Tesla's demand equation, because a lot of people want to buy the car and not everyone can afford it. There's a complexity loaded into the government's EV tax credits, which make it a little bit more of a confusing endeavor for people who want to take advantage of that. And Musk has tried to tweak pricing in order not only to make sure that as many people can buy the car, but as many people can flow through that tax credit offering. But again, there's no question it's going to have downward pressure on margins, both in this quarter and going forward. And that, of course, only increases the pressure on Musk to be able to ramp up production to meet demand, because, of course, you don't want both demand slumping and margins narrowing at the same time. But an interesting aside, JD, and I do wonder if this is going to turn out to be more important going forward, is the fact that Tesla is opening that gigafactory in Mexico. I think 12 months ago, we would have said with certainty that any expansion in the production facility is going to take place in China because of the success of Giga Shanghai. But Tesla, like a lot of other companies, is starting to wean itself from that supply chain dependence. And I think choosing Mexico was, at least in part, as a result of that thinking. And you do wonder what kind of knock-on effect that might have going forward.
All right, time now for a rapid fire section. We'll try and get through this quickly here. First up, breaking up isn't easy. Adidas sees.
So
sorry,
good.
I didn't read that ahead of time.
Yeah.
Adidas sees 2023 lost link to Kanye. Thank you, producers. What's going on there, Martin?
That's such an excellent headline. Adidas had to slash its annual dividend by about 80% as a result of the loss that it's likely to take this year from its separation from Kanye West. The rapper, of course, was dumped by Adidas as a partner in design and sales as a result of some disturbing anti-Semitic and other comments that he made through social media. But it's going to cost Adidas. They're probably going to lose about 1.2 billion in sales this year, and they're going to have their first overall loss, very likely in about 3 decades. The new CEO says they're going to climb back, but this is going to be a transition year, and the dividend cut really illustrates that.
Okay, number 2. Sorry, as I drink, that's my Marco Rubio moment right there. All right, the Buffett
Into that.
boost. Occidental shares jump as Berkshire CEO boosts stake. What's up with that?
He owns about 22.2% now, JD, of Occidental Petroleum. It's a Permian-based driller. They're a company based out in Houston. And he has permission to go over 50% from the Securities and Exchange Commission if he indeed wants to. I think this has been an interesting acceleration of purchases for Warren Buffett, because it is it's not only a play on the energy sector, but I think it's a defensive one at the same time. Occidental returns a lot of cash to shareholders, both in terms of dividend and in buybacks, and they're probably going to do well regardless of what happens with respect to the U.S. economy, which Mr. Buffett remains bullish upon, but doesn't necessarily reflect that in some of its investments.
Absolutely. Okay, on to number 3 we go. Flying high, Boeing has reportedly made a 737 MAX deal with Japan Airlines. How big of a deal is this?
It's reasonably big, JD. I mean, it's 20 aircraft, 737 MAX. It's going to be a mix of a couple of the different models, the 8 and the 10, to Japan Airlines. So we don't know the list price, and very often list price isn't what the airlines pay anyway. It's more of a number to sort of buffet the order book of the aircraft makers. But a couple of things I think are important. Firstly, Boeing appears to have beaten out Airbus for this order, which is no small beer. And secondly, it's a decent sort of consolidation of a $34 billion deal that they inked last month with Air India for 787 Dreamliners. So this is good back-to-back headline grabbing for Boeing, which really needs it because they've been suffering for a number of years now as a result of some very significant manufacturing sort of snafus and deadly airline crashes, it has to be said as well. So investors are probably going to look with favor upon this. The order book for Boeing is over $400 billion and about 4,600 airplanes, and this simply just builds on that.
Which is no small beer. You think I was going to let that one slide? You think I didn't pick up on that, Martin? Of course I did. I'm now laser focused for that phrase anytime you use it. Okay, fourth and final, madness is approaching. Will it be a record year for sports betting? Ugh, best time of the year, college basketball. Let's go.
It really is Selection Sunday coming up, isn't it, JD? I mean, the anticipation is last year about 3.1 billion was bet across the whole of March Madness. And the number that really stuck out to me was about 45% of Americans placed at least one bet over the whole of the tournament, whether they did it legally or through an office bracket or through a sports betting book in one of the legalized states or did it online. Everybody seems to want to participate in this because it is indeed so unpredictable and so much fun. So the anticipation is the number is going to be much higher than 3.1 billion, but interestingly, JD, much lower than the expected, the estimated 16 billion, which was bet on the Super Bowl. I'm taking these numbers, by the way, from the American Gaming Association.
Well, in the words of the great Jalen Brunson, Cats play tonight. Go Cats. Villanova tonight at the Garden, opening up for the Big East tournament. We are so excited here in New York for the Big East Selection Sunday and, of course, the big dance ahead. The great Martin Baccardax, thank you as always, my friend. Great conversation as always.
Thanks, JD.
You got it, man. We'll see you soon. All right, folks, that's going to do it for The Street today. Stick with TheStreet.com for more on these and all of the major market stories that matter to you, and we will see you tomorrow.